Hi, this is Randy Finning with Right Side of the Chart, and this is video number 2 for Tuesday, September 6, 2022. I want to cover a few other things, just a brief update to the previous video, tell you what I'm seeing here. I'm tape reading today. I'm an old-fashioned tape reader. That goes back to yesteryear, days of Jesse Livermore. It's a rare and dying breed. But I'm watching the tape. I'm watching the price action, and I'm watching a few other things. I'm going to cover those today and tell you that, I was long. I'm going to stay long and rode up here, and I've been, like I often do. I'll tell you, my swing trading positioning, and then I'll trade off this 5-minute chart and the 10-minute chart. That's what we're looking at here on NQ. So we rallied up to resistance today, and we had, and we're still above. We're still above those trend lines in ES. So I may get back long again, but I've decided to reverse it there just to play a quick pullback trade. Which I did, and then went and reversed it again back long. But we took out this level, so and I went short, and I'll stay short unless we recover that. And again, don't go off what I'm saying in these videos, because as I told you, I'm going to pivot. You got to stay flexible. But number one, so far, now we have, again, I'm going to get to that in a second, we have not taken out that trend line in the S&P 500, and we very well may today and get a bounce there. So I will do an update then, and if we get a bounce, and here's I'm going to look at energy and talk to you about that as well, because remember, I have a fundamental theory. It meshes with technicals, but it is that we're looking at, I believe, a big abatement in inflationary forces, which then would be a net bullish thing for the stock market. Now the problem is, what I've always struggled with is being too far ahead of the markets and the masses and what they see, by interpreting, extrapolating or interpreting from the technicals what's going to happen, and then marrying that with fundamentals. So if that doesn't make sense, what I'm talking about is, again, a drop in commodity prices, a significant drop, and that's going to then give the Fed a lot more breathing room, and ultimately, and then again, it's all about sooner than later. And most importantly, am I right? And does that play out? And I'll get to that in just 1 second here. And then B, as importantly, as far as your trading goes and investing, swing trading, even if I'm right, how long is it going to take for the majority? It doesn't have to be everybody, but just the majority, especially institutional traders, to see, what I'm seeing or what I'm predicting. What hasn't happened yet, but if it does start to happen, meaning a drop in inflationary pressures, and therefore the Fed will start to back off. And I promise you, Powell talked tough talk, because he ate a lot of crow and he feels like an idiot, as he should, staying too long on that whole transitory thing, and now he has no choice but to talk the tough talk. And as I said, what he did last week before last at Jackson Hole was called jawboning the market. He didn't come in. If he was really serious about fighting inflation, he would have come in with an intermeeting rate cut. The Fed used to do that at when things got really out of whack. But no. So what he does, and what the Fed has been their primary tool for many years now, is jawboning the markets, trying to talk about raising rates or cutting rates when things get ugly, instead of actually doing it. Although they've been a little more quick on the trigger to cut rates when things get ugly than they have been to raise rates. They usually try to temper rallies in the market, and by jawboning. So all right, let's get to the chart. So that's it. Just intraday, I'll continue to watch this and tape read and try to figure out. But I'm seeing just a lot of selling pressure. The bulls have had plenty of opportunities, and look, again, they have not dropped the ball yet. They just haven't picked it up and run. And I'm talking about stepping in here. Here is the S&P. As I'm doing the video, right back to that same very trend line. I zoom in real tight here. I got to get off my volume bars. See, we hit it here on this candle right there, the 11 a.m. candle. We made a tag of that trend line when I got that first video out to you. And then here we are again. We're on it. So as I like to say, support is support until unless broken. And, based on that, I'll tell you what, for kicks and giggles, let me just look at one other chart. I may just cover that short and go back long real quick here. Yeah, that's what I did. All right, so I just reversed NQ from a short back to long. And again, here's that trend line. There's the, you zoom in tight, that trend line should be a hair lower on ES. Let me just fix it. If I can grab it. This charting software isn't always the most conducive to moving these trend lines around. There it is right there. I'm trying to get it right on that point and right on that point there. I have to pull that up a little. Then I have to drop this in. See, it's all right, close enough. The trend line should be a little bit lower from where it is. It's off the end of the chart, so I can't grab it without dragging everything around. But they still have the divergence at support. So that's the boom. Anyway, so kind of erase what I said about pivoting. And now I will, how we close the day is going to be important. Again, I think, and I said it earlier, I think this is going to be a pretty big week. We're either going to be up by the in the next few days here, probably very strong, easily 3% plus rally, maybe even quite a bit more, maybe double that, or we drop hard. We're at a point where, again, the market's about to break, but on the flip side, here's that whole energy thing. So let me just jump over to that, and then I'll get back to these equity charts. So just remember, we're about where we started today, earlier. No change. Like I said, I've seen a few failure to launch rallies, and that's why I've been kind of just gone back to my old school day trading habits of jumping in and out on those 5-minute charts. But as I said, as of now, back to the longs. Because we're still there. We're still at the trend line support. And then let me get to what I wanted to cover for you here. Now I covered it this morning. That was the first post of the day I got out to you because that's where I'm, carrying the probably my biggest position right now, beta adjusted, not necessarily in position size, but when you beta weight a position, meaning the amount gain or loss you're going to have, because that's here's natural gas that's down 5.5%. And that might sound like a big move if you've never traded it, but that's just par for the course. This is, this thing many times been in this thing, and it's been up well into the double digits, 10, 12, 15% in a single day. So 5% again is run of the mill. But what's important is this chart. Here's that 6-month chart I showed you. That was the first big drop in natural gas, and we caught most of that on the short side. All these little trend lines, little divergent highs, and it doesn't look like much, but these are 20, 30+% swings right here. We built that divergence. Then we had a sell signal and a powerful breakdown. Now that's one thing we haven't seen. Once it becomes clear to the masses, that's usually when you get these big moves. And from high to low, I'm just going to measure it out for you. That last divergent high, then back earlier this year, before all is said and done, we fell. That drop was 45%. All right. And this one right here is a divergent high as well. We're on that 2-hour chart, same chart I gave you this morning. I didn't extend those lines out. The divergences go like that. Sometimes they kind of just vanish on my charts. Don't know why. But there's the 8379 on this time frame. That's where I had the support level. Remember, I had it a little bit higher on the 60-minute I gave you before. And so far, we're down about 15%, 16%. So number one, I know a lot of people won't want to short at anything that's fallen 15, but I still think we have quite a bit more to go. My next target's all the way down here, about 20% lower, 751 or so. If that plays out, and look, we're starting to crack that level. Now we go back, we zoom in a little closer, we go down to my hourly chart. Same one I gave you last week, same one I've been giving you for the last couple weeks. So you've had several copies of this in both the videos and some screenshot charts. There's the uptrend line. There was our bearish rising wedge. There was our divergence had been building, and we stair stepped lower. Then we broke that support level, and then I was waiting to see this one go, which it went, and then waiting to see that one go, which it's gone now. And you can see this divergence is right now we're pretty much pushing the bottom limits of positive divergence on the 60-minute, meaning these are flat. The PPO and the RSI are making about equal lows with prices making lower lows. So technically speaking, it is still positive divergence. It's unconfirmed. That's what I call it. But potential divergence if we reverse now. And what would do the trick for the bulls? Bull trap. I'm sorry, a bear trap, solid move back above, let's say 850. And then there's a trend line here, even better if they can take that out. And all these resistance levels on the way up. But I think we're going to get this, and that's again a pretty big drop down to that next target there, and quite possibly more. That last divergent high we fell 45%. And again, as I said earlier today, let's not forget the news on natural gas couldn't be any more bullish, right, for natural gas prices. Russia, they were already at last week before they shut down the pipeline for quote unquote scheduled maintenance, which I keep doing. They were only at 20% flows before that. They said they'd open it back up on Saturday, but yet on Friday, I told you they fired a salvo, or at least in response to the G7's threat of trying to instill caps on Russian oil. Russia just said, "Oh, we've got technical problems," which obviously, and you read the articles. I'm not an expert on natural gas, but all the experts said is, even Siemens, who makes the turbines that pump that natural gas, said it's highly unlikely that they can't pump the gas, that they have issues because they have backup turbines and all that other stuff. So anywho, again, you probably read the headlines. If you trade natural gas, you should. But where I'm going with that is, so when you have nothing, and I mean absolutely nothing but headlines that should be bullish for natural gas prices, meaning making it go up, and yet it still goes down, that's quite bearish. And so, hey, anything can change, but as of now, we have both technical bearish evidence, meaning a break of those next support levels, price targets, and fundamental bearish evidence, reason to be short natural gas, which is natural gas prices going down despite news which should cause it to go up, i.e. The complete cessation of Russian gas flowing to Germany through the Nord 2 pipeline. All right, so that's that, and just shows supply-demand dynamics have shifted. Anything's possible, and it's easy. Look, we rally back up, start regaining these support levels. It was a false breakdown, and maybe natural gas does shoot up and have another high. Certainly possible. So if you are short, don't get married to it. But going back to what I said, the biggest drivers of inflation, at least the ones we can control in real time. Housing market, I already covered that last week, showed you that we've seen a definite shift. I continue to watch Zillow, see more and more price drops coming online and things like that. I showed you the trends, but there's a big lag in the reporting data. There's no real-time accurate indicator for the housing market because of the way real estate transact. They don't trade liquid on an exchange like the stock market. So therefore, our best guide is to watch commodity prices as a whole. And I told you my my favorite proxy, what I think is one of the most accurate, is DJP. Tracks a very well diversified commodity index, the USB Dow Jones USB Commodity Index. And I've shared this quite a bit. Put in a divergent high here. We've been moving down, rallied back to resistance, got rejected there, broke down from this rising wedge pattern, been steadily moving lower since, coming up on these 200-day moving averages, which acted as support. If we take those out, then that should bring us down here to my $31 target, in which case I'll be looking to go long at that time, especially if we get this big positive divergence, which I think we'll have if it happens soon. What's going to cause that to happen? Well, there are no guarantees, but we can look at the sector weighting. It's 40% energy, so stands to reason if natural gas and crude go down, because that's pretty much all of the energy in there for the most part, crude oil and crude derivative products, which is what that is made up of, like heating oil and stuff like that. And then that's that. So again, I'm trying not to make it too complicated, but it's pretty simple. We see both natural gas and crude correct substantially, you're going to see a very substantial abatement in inflation, and then sooner or later you're going to hear the media talking about, and then ultimately the Fed talking about, oh, our interest rates hikes have worked, and you're going to see the dot plot, or the expected trajectory of Fed hikes go down, and maybe even talks of them pausing. And again, it's not if that happens, if we get that abatement in inflationary forces, it's not a matter of if, it's just a matter of when are they going to start talking about that. And then more importantly, when's the market going to see it? Are they going to see it before it actually happens, like what I'm trying to do here by using the charts to predict it? Maybe, maybe not. I'd like to think there's others out there, and maybe my analysis is wrong, but if I'm right, and I think there's going to be others that try to get in front of that trade instead of waiting to read about it. Because I've always said this, if you try to trade reading the newspaper or getting your tweets on your phone, or Barron's articles and things like that, you're driving by looking in the rearview mirror. By the time most headlines hit the press, it's already priced in and the move has already happened. So you gotta, kind of gotta be ahead of that stuff. All right, so there it is. There's UNG, natural gas. Like I said, it's been on. We had a sell signal back here. It continues to move lower. So far, so good. That was a big divergent high right here. You can see it down there. And, we can easily fall down here. I think it's a very likely target, that 2270-ish level, and that's about another 20-21% drop in natural gas from where we are, if I am correct, and quite possibly more, maybe even a 33% drop from where we are, and that's not from the top, but from where we are right now. So let's just, as long as the charts are constructive on the bearish side, then I'm going to maintain, that outlook. And right here, USO has been just consolidating. This is massive support. Crude oil, talked about it, about on USO, the ETN that tracks it, about 69.50 up to about 71 support zone. And a solid move down there. We'll go to my long-term swing target, which is this uptrend line right here. And the 58-ish level right there. That's USO. I'll show you crude futures in just 1 second here. But there's the up. Nope, that's not it. That's the wrong tool. There's my uptrend line tool and price resistance. And let's measure that out for you. That would be from where we're at today, about, if hit, about also 20%. So if I'm right and you get a 20% drop in both crude oil and natural gas, you're going to see the Fed pivot. All right, and you're gonna hear about it all over the place, that these rate hikes are working, and they finally got a handle on inflation. And just when everyone believes that inflation, maybe the Fed was right and was just transitory, it just took a while, or whatever reason it wasn't transitory, but their rates stopped at their rate hikes, that's when you want to get long commodities again and short the markets for the next big leg down. So I'm still working off that whole thesis. It's multifaceted, and it may or may not play out. But the thing is, I'm going to trade it if and as it does. We break down on crude, because natural gas, I just showed you, I'm on sell signals. I'm pretty heavy short natural gas. Crude oil is right on the brink. We're right on support. Let me look at crude futures for you, and then I'll get the video out to you guys. All right, CL. This is this is a 2-hour chart, 6 months price history, 2-hour candlesticks. 85, 89. So rough, not a hard level. But you saw it better on UN. It was also a zone on UNG that I just showed you. So that's pretty much it. We've been dancing to kind of summarize everything. We topped here. Crude peaked a while ago. That's not really, I don't think it's being talked about as much. Crude oil is already down from that high right there, mid-June. Coincidentally or not, what is that, 2 days before the stock market bottom went long. You can see that crude fell, 25% so far. So, and that was, a few months ago. So safe to say that was at least a temporary top in crude. We can say that clearly in hindsight now. And again, it wasn't random, just like the bottom in the stock market then wasn't random. It was priced in. We talked about it at the time, covered all shorts, started going long there. And then crude oil also topped. And that was a big catalyst rally. A catalyst for the stock market rally, because there was that abatement in inflationary forces. Then you had this bullish falling wedge. This is where the crude bulls, ball was in their court. You had a bullish falling wedge, as I've just drawn here and here with that downtrend line. Here, I'll do it again without all those blue lines there. And they had the potential to take the ball and run. It broke out and then put a little divergent. I came in and back tested, but what happened, instead of taking off after the back test or the breakout and heading on to new highs, the breakout failed. Now we're back down to support there. We're really right about on the trend line. So again, I can't at least make a super strong case to heavily short crude right now, but very soon, once it breaks this level, I can. And I'm going to jump out to the daily chart, show you that. And right there, let's go. I don't think we need to go back 2 years. There, go back 18 months. Look at that. Look at that support shelf right there. About $85. It says $85.12 there. We'll call it $85. This goes all the way back to the beginning of the year. This is February. It was resistance. We broke it, ripped after that breakout, after some consolidation there. Back tested it. Those are three distinct daily candles. Perfect back test. Successful rally. Back tested again. Exploded higher, but failed to make a new high. Made a slightly lower high. We'll call it an equal high. I think maybe in spot prices it might have made a marginal new high, but either way, call it a double top. Pulled back down and boom, testing. If you're a crude bull, you buy here. You buy, it's TA 101, trading 101. Buy pullbacks to support with a stop below. Maybe it'll rally. And you do have positive divergence there. But that was that same divergence that we broke out, but then the breakout so far has failed. But looking at it from this perspective, and this is what you need to do. I always say, depending on what time frame you're trading, those hourly charts will get you in and out quicker out of trades. They're faster for your entries and exits. But they also are more prone to whipsaws in the daily chart. So when we look at the daily chart, I'm going to say it. Look, there's still. This is why I just said I can't bet the farm short on crude right now, or call it a breakdown yet, because we're still at support. And as I like to say, just as I've been saying with the stock market, the S&P 500 testing that uptrend line, support is support until and unless broken. So as ugly as the price action's been lately, as ugly as the price action is on the weekly charts, we're still at support with positive divergence on the daily in the stock market. And with crude, we're still at support or just a hair above it with positive divergences that were recently put in. In fact, those divergences just extend here. If we make an equal or a marginal new low, we'll still have positive divergence. And so there's still the potential for crude to rally on up and make another high, or maybe even pop those old highs. That would be extremely ugly for the stock market. The Fed would have no other alternative than to be pretty aggressive on raising rates and to really, we'll already be in a recession. Heck, the Fed could sit tight where they are now, and if oil has another run up, it's just going to be the final straw that breaks the consumer's back. As I don't have to tell you, just about everything comes back to high crude prices, things that you might not even think, even food prices, grains. They don't walk themselves from the field to your grocers, or your cupboard at home. So there's many stops along the way, all labor and energy intensive. I'm sorry. So down to that, plastics and air travel and you name it. All right, so that's that. Need to see this. We get this, boom, it could be a nice drop in crude. I'm talking about a solid break, one that doesn't just prove to be a whipsaw. You can take the short, take it on face value, and just if you rally back up and recover it with conviction, then you might want to cover that short. If you see that, turn back, look at DJP. Remember, again, crude and natural gas are your biggest. They're pretty much the energy sector for the most part. And here, of course, coal is a smaller thing, but coal is going to follow crude prices and all that. But you want to watch this as well. Remember, cotton can do what cotton wants to do, and it's not going to offset the inflationary pressures that crude and natural gas put on. But you can watch the rest of it. But so that's it. There's where I think we're going. I think we're going to have that temporary abatement. Stock market looks like death right now. It is, I think, on the verge of a technical cliff, and it may break down. And that breakdown may or may not fully play out to my next target on the weekly. I keep talking about that, but I do forget sometimes. New folks are coming into the site. This is a target I maintained since before we even topped, in the beginning of the year, and still maintain. It's my fourth and final, what I call initial bear market target, down here at about 235 on QQQ. And back before, after we topped, I measured it out. It would have been a 42% it will be a 42% drop off the highs. But the last target we hit was T3, and we got that bounce there. So really, this is certainly possible, but I'm at this point in time, if my everything I just talked about in this video plays out, I think we'll get another bounce, and there will be, once that all runs its course. And who knows, that bounce again, if we see a 20+% drop, an additional, let me correct myself, an additional 20+% drop in crude and natural gas, and you see a lot of other commodities go down. It's going to change the narrative from the Fed, and at some point it'll most likely change market expectations. Now the $1,000,000 question: is the damage done? Because every bear market, once you get into it, I think 2008, the Fed started cutting rates, and you reach a point where you got so high and valuations got so out of whack and everybody was so one-sided bullish that the damage is done and the darn thing is going to play out. So I have very little doubt this bear market has begun and it's not over and it will play out. To me right now, it's just a matter of, is it going to play out like this with one final impulsive leg down before a nice trend and swing tradable rally, or are we going to continue to zigzag and work our way down there? And that's kind of what I'm going off of right now. But that, as I told you, can change as early as today, depending on what the market does today and this week with these support levels we're at. That will play in. And then the other thing I'm watching is, these, remember I told you to be long in bullish equities is to be long in bullish cryptos, and they did start to rally. But just today, this is a 6-month chart. Look at Bitcoin. Bitcoin, just like the stock market, constructive chart, potential to rally, nice divergence. I covered these cryptos quite a bit recently. See the divergences in place. Even if we undercut this low, this is big support, about 18,715. So again, if the stock market can hold here, even with a little fake whipsaw breakdown below that S&P line and rally, crypto looks good for a big rally. But otherwise, they're starting to dump it finally today. They're giving up. Again, the market, I haven't seen this in a while. It's had a lot of opportunities to, let me just show you today's one, or go to a 1-minute candle. See, this was crypto. This is just today, Bitcoin. It was holding, and people are starting to give up because the stock market just can't seem to rally off these with these positive divergences and that failed bullish falling wedge breakout last week. Remember on Friday we broke out, we were ripping, and then they turned around, and I told you it was uncharacteristic. It was bull market action, characteristic of a bear market, I should say, to see that big reversal. But even then, crypto held up. But finally, look at this, just in the last few minutes here. This is just a 1-minute chart. This is 1 p.m. today. Bitcoin has plunged about 4%. Ethereum was doing well as well. They're giving up, and you got the little wedge on Ethereum here as well. This is the futures. ETH USDRR, told you that. I was long in that because I was long the equity markets last week. But look at that. You're starting to sell it off here. You've got an uptrend line here. Until they break that and the stock market continues lower and breaks support, you're probably going to see another leg down. If the stock market can hold this level, even if it's with a whipsaw down through that S&P trend line today, but back up at some point this week, ideally today or tomorrow, then crypto has a chance to continue to run here. It will. It's been a risk on, risk off. But what I'm trying to get to here is, just when I look in right before I started this video, I'm seeing a lot of people finally throwing in the towel. See, this was Ethereum. It was holding up, and then all of a sudden they're just, it seems like everyone's giving up on the stock market's had a lot of opportunities to rally today, and that's why I told you I've been kind of flipping back and forth using those 5-minute charts, and I'm going to continue to do so. It's looking less and less likely that we're going to rally. We had the breakout on Friday, started to run, it got sold in too hard, hit the trend line today. We've had numerous opportunities where the bulls should have stepped in, and so far they've stepped in, but not with vigor. Each time they step in and buy on that trend line, the bounce is weaker and weaker. Again, it hasn't gone yet, so I haven't written it off as of yet, but you can see some people starting to throw in the towel here on crypto. That's a almost a 5% drop just in the last hour or so here, not even an hour. So we're going to watch this stuff, and that's it. Watch all those things. Main things, commodities. But remember, maybe oil breaks down. Natural gas has already broken down, continues to fall. At least hopefully some of you guys are profiting on that, guys and gals. And I think it has more to go. But even if crude breaks down, there's no guarantee the market will rally right away. Because again, the problem sometimes with this thing is being too early. Seeing something you're right on that, but then it takes a while for everyone else to see it and for it to play out in the fashion that I told you about, where it finally permeates into the mainstream media and the general public, and more importantly the the hedgies and the institutional traders. When they start buying, everything goes good. If the problem is with the institutional traders, I've talked about it, pension funds, This is, one reason I've called for such a big bear market all along is I've said it for the last couple of years, for the first time in modern history, in my lifetime and just about any of yours. This has been the worst time for traditional investors, mom and pop investors, institutional investors, especially pension funds, because the old 80 or 60-40 rule of stocks and bonds doesn't work anymore. It used to work because when stocks went down, bonds would go up. Number one, because the Fed has screwed everything up, bonds have been falling in line with equities. Look at the stock market's down today, and so is TLT. It's still in that price channel I told you about, and I still think it'll break out here, and I still think it looks good for a rally soon. But it continues to fall with the stock market. And again, historically, the opposite happens. Stocks fall and bonds go up. So these pension funds are getting crushed. They have nowhere to go, and their old risk models that worked for 100 years, being diversified among stocks and bonds, isn't working anymore. And that's because the Fed artificially kept rates too low for too long, took it to the floor. So therefore interest rates had nowhere to go but up, which meant bond prices have nowhere to go but down. And so finally that coincided with an extremely frothy and overvalued stock market with negative technicals. And Fed thought they could keep rates low forever and inflation wouldn't be a problem. So they backed themselves into a hole that they should have seen coming, and that's where we're at right now. And so where I'm going with all that, I'm talking a lot about this stuff, is that what could just break the market if we can't rally soon, if the stock market doesn't hold support soon, if it continues much lower, especially if the selling starts to snowball, you just see forced liquidations. You see individual investors panic and sell. You see individual investors and active traders that use margin to get forced margin calls. They don't want to sell. Let's say they're the iron fist, or what do they call them, diamond hands. But guess what? Your broker sends you an email, or you get a thing that says, hey, you've got a margin call. Either you sell your, some stocks, or we're going to sell them for you. And then that is a domino effect that happens in every bear market, the unwinding of the margin bubble. And so that, coupled with the especially pension funds, they have a fiduciary responsibility to not lose their investors' money. They have to start selling equities to reduce their risk exposure. And so then it's a domino effect. So I think we're on the verge of that, but we're not there yet. But if we keep going down, especially if stocks and bonds continue to fall like this, you could hit that flash point. And we could be down to my next and final target on the weekly chart in very short order. But as of now, I'm betting the other way. And if that changes, and it probably will this week, if it's going to change, I'll let you know. All right, I'm going to wrap it up here. This has been Randy Finning with Right Side of the Chart. Have a great day.